Welcome back to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Online, zinniawealth.com. You can find it anytime. It is ZINNIA wealth.com. All right, people are always asking, where do I put my money? They know I do this show with you, Sharice. They ask me, where should I put my money? I just go, talk to Sharice. And so anyway, there's an article in Wealthopedia, and it says, well, here are some places not to put your money. Okay, so they have 7 of them here. So I wanted to get your thoughts on this because people come in all the time and they have money in places, and you might say yay or nay. We have to adjust this. This is good. Let's leave it there. Let's get rid of this. Okay, so the first one on the list, not shockingly, is variable annuities. So we've talked a lot about, the downside of some annuities, Sharice.
Yeah.
And this is kind of at the top of the list, isn't it?
So where not to put your money, number 1 on my list, variable annuities. Oh my gosh. Variable annuities are loaded in fees. Most of them, I would say 9 out of 10 of them are loaded in fees. They usually start at 3%. I've seen them as high as 5%. I will give you an example. No joke. This week, we had a family come in and we're reallocating their assets. I'm like, oh, hey, Sharice, we got this variable annuity still. I'm like, variable annuity? Where did that come from? Literally, they've had it for 5 years. They literally just came on board with us, just so you know. But they've had it for 5 years. They put $425,000 into it. It's 5 years later at $450,000. And that's because the fee was 4.5%.
Oh, wow.
So you got to make 5.5 just to break even. So I said, well, why don't we just roll this out of this variable annuity into an index annuity that has no fees? When we moved that variable annuity to the index annuity, they got a bonus. So it went from $450,000 to $500,000. They're like, wait a minute. We just made 50 grand on it. I said, yes. And your cap on the S&P 500 is double than what it's at right now in your investment. And now you'll have no fees. They went, OMG, Sharice, whoa, that is like magic. And I'm like, it is. So again, I am not a fan of variable annuities. So big thumbs down.
All right. So there's a lot of annuities out there, really thousands of them that you can choose from. And Sharice, do you use, how many do you actually use?
So there's thousands of annuities out there, and we really stick to the index or fixed annuities. And I can count on my right hand how many we offer.
Interesting.
And there's 5 out of thousands. And we like real indexes. We don't like fees. We don't want losses. We want to be able to take a withdrawal out of it. So these aren't your grandma and grandpa's and your mom and dad's annuities, these old school annuities. These are the new age growth annuities with no fees. And if a lot of people hear about these hybrid annuities, most people don't need a hybrid annuity or equity index annuity. We like those. Variable annuities, no. Out, scram, move out of the way.
Get rid of them. All right. So number 2 on the list of the things where you shouldn't put your money, this was interesting to me, whole life insurance. And I remember when I was young and just got married and needed life insurance, and that was offered to me, but boy, it was expensive. So I decided to do what everybody else does, and I did term. And then I ran into a problem when I got into my 50s because that term policy expired. Now I got to buy insurance, and now it's really expensive. So
let's talk about whole life insurance. So the older we get, I believe we don't need whole life insurance because of the cost of whole life insurance. If you get whole life insurance, it's actually better to get it when you're younger because it's going to pay a dividend. And as long as you hold it for 30 years, it is a more expensive policy. After 30 years, you're probably not going to have to pay a premium anymore. So there could be some value there. But when you're younger, you do term to cover the mortgage and cash flow if you happen to pass away early and you have kids and the surviving spouse needs income. So, but that term runs out after 20 or 30 years. And so you got to plan early. So it's not just about term early on. If you're looking for a potential investment for the long term, people can do whole life. But again, I'm not a huge fan of it.
Next one on the list of places where not to put your money. And I will tell you, folks, there are trillions of dollars in these, and they are in your 401k in target date funds. And we've talked a lot about them. What is the problem with target date funds, Sharice?
Okay, so boom, boom, boom. Target date funds. I am not a fan. Things that we don't want to invest in, but sometimes we're forced because we have a 401k. You have a small menu in your 401k and you're forced. But hey, here it is. Target date funds, they don't protect and they don't make as much money as you think they should be making. So I'm just not a fan of target date funds. They tend to have a little bit more fees. If you're with an employer, I'd rather you stick to the mutual funds, even though I'm not as big of a fan of a mutual fund. But if I had to choose between the two evils, I would pick mutual funds over target date funds. So if you have a 401k and you're like, oh, I got them both, come in and see us. We'll analyze your 401k, because I was like, let's get rid of that target date fund. And we can tell you why when you come in, and pick the juicier mutual funds, because in the long run, we feel like you're going to make more money at those.
Well, if you're 59 and a half, you do have that option of moving money out of your 401k to give yourself some more choices. So, Charisse, the idea of a target date fund is that they will add more bonds as you get closer to retirement, supposedly giving you less risk and more protection. But if you start to look at the performance of target date funds, sometimes you could pick one like a 2065 fund and find it doesn't do that great. I mean, there's a lot. You got to look at the performance of these things.
Yeah. So second reason I don't like target date funds is that as you get closer to retirement, it reduces your risk to equities, gives you more bonds. And you don't really know it's happening, but it's happening. But if you're 10 years before retirement, I don't want my clients to be in bonds. We got 10 years to grow our money, maybe as we're 5 years before retirement. So you have no control, and it just does it. And then I feel like you lose out on the up of the market when maybe you might not even be retiring till later. So this is why that financial advisor is good to say, nix that target date fund and let's go with the mutual funds and play it heavy for the short term. And then we can slowly build in the safe strategies as you're, 5 years into retirement. So you really got to plan.
All right. So our list here of places where not to put your money that we're going through: variable annuities, whole life insurance, target date funds. Next one on the list is 401k selections involving company stock. So can I say one word to you? Enron. I mean, honestly, there is some risk when you put money into your own company stock. I don't think that's a bad thing, but it's all about how much, isn't it? It's the allocation.
So when we're talking about where not to put your money, a lot of employers, they will give you company stock at a discount, right? So let's say you work at Duke and the stock's at, for example, $35 a share. Maybe you can get it for $30, right? Because you work there and you're saving. But a lot of people will retire with all this company stock. 75% of their money is in company stock, and that is not diversified. And some of that stock, depending if it's qualified or not qualified, you're having to cash it out over the next 5 years, have be hit with some pretty big taxes that you weren't expected. Some of them are just in IRAs, and we got to slowly exit those stocks. So again, there needs to be a plan for those stocks. And I prefer you to, okay, let's take some of that stock, but let's also sprinkle in some other things that 401k has, so you have some leverage when you're ready to retire.
The next one on the list here of places where not to put your money, and I'm in the dark on this one, Charisse, is a stable value fund. I know that that's probably in your 401k. What is wrong with a stable value fund?
So another place not to put your money in a 401k is a stable value fund. And the reason why is because it's stable. Very little value to it. It's not making any money. And so when interest rates tend to go up, they do make more money. But on average, we're looking at 0.5%, 1%, maybe 1.5%. Why is anybody's money in a stable value fund? That just means that you are ultra conservative. You're not sure where to park your money, and where there are some other options that you could park your dollars and still keep it rather conservative, but maybe make 3%, 4%, 5%. So I'm not a big fan of it, but people put their money there and they leave it there because it's safe. So that just means they need to reassess their risk and figure out, okay, if I'm going to be this safe, how can I make more than 1 or 2%?
So could I say at this point in this is you talk about active management. What these things are trying to do is do management of your money inside your 401k. If you're 59 and a half, you have that option of moving that money out and having it managed by someone like Charisse. And is there anything that these things are doing that you can't do?
No. So when people turn 59 and a half and you have a retirement account, a 401k, most companies, 9 out of 10, will allow you to do an in-service distribution. You can still contribute. They'll still do your matching, but you can usually move 50% or even all of it out to an IRA and start working with a local financial advisor. And the difference is you have 30 options with your employers in these 401ks. When you come to us, we have 30,000 options. Now talk about sky's the limits, right? The world is your oyster. Take advantage of it when you get the opportunity to do that. So be calling calling your employers now, if you're 59 and a half and older, and say, hey, can I move this out? Can I start working with an advisor and still contribute to this account if I'm going to work for a couple more years and still get my matches? And 9 out of 10 times, they're going to say yes. And when you move your money over, there's no taxes, there's no penalties. So take advantage and be aware of what you are allowed to do, because if you do, the potential of growth or strategic planning when you want to retire in a year, 2, 3, 4, or 5, you're already ready to rock.
Love it. All right. We're going through our list here of 7 places where not to put your money. It started with variable annuities, whole life insurance, target date funds, 401k selections where you've got company stock, stable value funds, and the next one is mutual funds with loads. So explain that to me.
Mutual funds with loads. We talk about this in our workshops. We talk about it on radio all the time. Mutual fund with loads just means, okay, so we went to a big bank, we went to a big brokerage firm, you find them on every stoplight of the corner as you're driving by down the road in any city you're at, and you walk into those brokerage firms and banks, and all of a sudden you say, hey, you know what, I think I'm going to invest my money here. And like, oh, we're going to put you in 4 mutual funds. Oh, great. Dave Ramsey said, put your money in mutual funds and set it and forget it, right? In the meantime, you possibly 9 out of 10 times are working with a transactional financial advisor, and that loaded mutual fund will pay them, that's called a Class A share, will pay them 5 to 7% up front. So if you go in there and say, okay, I'm going to invest $100,000 and it pays them 5% that moment, like the next day they get paid, you're only investing $95,000. So for that advisor and for you to create a good relationship with them, for them to make more money off of you, they got to sell it and put you in something else. So we call it churning. Are they really doing the right thing for you? And so we're not a big fan of loaded mutual funds. I like no load mutual funds where there is no commission, right? So if the advisor is working for you, they're working for you, and they're not buying and selling to fill their pocketbook up. They're buying and selling because it's really the right thing for you in your portfolio.
Well, last on our list here, and Charisse has gone over this, and this just kind of sums everything up here, is people who just simply leave their money in their old 401k. Maybe you aren't even at that job anymore, and you've maybe got 3 401ks with old employers. Charisse, tell me why people should not leave their money there, even if it's probably performing well.
Yeah. One of the biggest mistakes that people make, I don't care if you're 30, 50, 60, 80, is that you bounce from job to job and then you leave these retirement accounts, these SEP IRAs, simple IRAs, these 401ks with these employers. And it's sitting making money most likely, right? But you just leave them and there's no plan. So here's the nugget here. If you have an old 401k with an old employer, do you know, it doesn't matter what age you are, you can actually now take control of those old retirement accounts, roll them to an IRA locally, pick that financial advisor that you love the most, and now they can start working on those dollars that might work for your future. So don't be afraid of it, because there won't be a penalty. There will not be taxes to do this. Do not leave your 401ks with your old employers. Move them, get control of them, be prudent, because I know you all want to be, and I know you all want to learn a little bit about this stuff. So if you work with somebody locally, guess what? You're going to learn some stuff while you're moving it over.
All right. So maybe as you're listening to this list, you go, I've got a few of those. Variable annuities, whole life insurance, target date funds, 401k and company stock, stable value funds, mutual funds with loads, and leaving your money in your old employer 401k. That's the list here of places where not to put your money. And where do you put your money? Well, there's the question that you can sit down and talk to Charisse about. Getting control of your money, getting active manage of it, and having somebody that you can work with, ask questions of, and we'll make those adjustments as our economy does its dipsy doodles, as we have seen over the last couple of years.
Did you just say dipsy doodles?
I did say dipsy doodles.
That was so cute.
It just came out.
Thanks for listening to the Retirement Coffee Talk podcast. If you have questions or would like to begin the process of building a tailored retirement plan, call Zinnia Wealth at 833-368-3680 or find us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Charisse Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and/or categories usually do not deduct transaction and/or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.